Good evening. This is the presentation of Group 6 under the name of Clydel Misarona, Faith Marisueco, Teresa Sinoy, James Lee Sinoy, and Rena Tokmo.
Okay, number 1. How do you calculate ARR? So this is how you calculate annual rate of return. I would like to give an example. Let's say our cost is 150,000. The salvage value is 10,000, and our annual after-tax net income is 15,000. First, you will add the cost and salvage value, which is 150,000 plus 110,000. The result are 160,000, and the 160,000 will be divided by 2, and we will get a 80,000. The 15,000 tax will be divided by 80,000, and RRR will be 18%. We simply divide the 80,000 and the tax, which is 15,000, in order to get the ARR, which is in the 18%. So, what are the implications of payback period? Longer payback periods are less miserable, while shorter payback periods are more appealing. I divide the investment amount by annual cash flow to determine the payback period. The payback period is used by account and fund managers to assess whether or not to proceed with an investment.
What are the variables to consider when calculating the payback period? What is its formula? Variable needs to consider in calculating payback period is cash flows, cost of investments, even cash flows. Add cash flows in each year until the sum equals the cost of investments. Uneven cash flows, payback period equal cost of investment, divide annual net cash flows. The cash flows are uneven. Therefore, to solve them, we just add the cash flows each year until the total equals the cost of investment. But the annual cash flows only require dividing the cost of investments by the annual rate cash flows to obtain the payback period. What are the two? Ikaw? Sige.
Number 3. What are the two budgeting methods we covered in our presentation? What are those of each method? The two budgeting methods are payback period and accounting rate of return. The payback period is a measurement of how long it should take for an investment to produce money that is at least equivalent to the cost of capital. To summarize everything, the payback period determines how long it will take the company to recoup its initial expenditure. Accounting rate is a concept that is frequently used to evaluate multiple investment and determine the rate of return, as well as to assist business in deciding which investment to continue with. As a result, we can quickly estimate the profitability of an investment. Businesses often prefer investments with a high TSRR rate if the returns are at least equal to the cost of capital.
Number 4. What is the differences between capital expenditure and operating expenditure? Capital expenditure are large expenses intended to employ the long run for the operating. Expenditure OPEX are daily expenses of the business to keep its operation running.